Good afternoon. It's Jeff Christian from CPM Group in New York. It's Thursday, the 14th of January, about 4:15 p.m. Wanted to talk to you a little bit about gold and interest rates and what's happened in the gold market and the gold price over the last couple of weeks. There seems to be a lot of navel gazing and confusion and discussion about why gold prices would fall last Wednesday and Friday, even as political events in Washington, D.C. were very critical. And I think the answer to that has to do with interest rates. But then I've always thought that interest rates were the single most important factor determining the value not only of gold prices, but also of most other financial assets. I also want to talk a little bit about Rhodium market. It's gotten a lot of attention. The price has skyrocketed. You know, it was probably $2,000 2 years ago. It was $20,000 earlier this week. People are saying, well, how do I invest in Rhodium? And so I'll talk a little bit about those two things. First things first, interest rates. As I've said, our view and our analysis and our econometric modeling that goes back to the early 1980s all suggests that interest rates are probably the prime mover for the asset valuation of most assets, including gold and silver. However, the relationship is extremely complex and doesn't really lend itself to econometric modeling, and it doesn't lend itself to simplistic analyses. Those of you who know us, know me, know that, you know, as many people have often said, Jeff Christian thinks that his job is to take a simple question and make it into a complicated answer. And the reality is that the relationship between interest rates and gold prices is very complex. There are people who talk about how higher interest rates will cause gold prices to fall. And we've shown extensively in our gold yearbooks over years and in special studies and in consulting to investors, that's not the case. And the correlation between real interest rates and gold prices is zero. If you look at a dispersion chart of changes in gold prices and changes in real gold prices and changes in real interest rates, what you find, relationship is pretty much zero. There are times when interest rates are rising and gold prices are rising. There are times when they're both falling. There are times when they're moving in opposite directions. Interest rates are rising and gold prices are falling, or interest rates are falling and gold prices are rising. The relationship is not nearly as simple as a lot of people think. A lot of people who don't know basic statistics don't look at the period-to-period changes in real interest rates versus period-to-period changes in gold prices. They take interest rates, which is the price of money, and the gold price, and they do a correlation, and they say, oh my God, there's a 38 or a 68 or a 78% correlation between interest rates and gold prices. A lot of times they're using nominal gold prices and nominal interest rates. So they have inflation baked into both of them, distorting the correlation. It's basic statistics, and people get it wrong all the time. And people at major banks get it wrong all the time. We've seen this for years. I mean, you know, Woody Brock, a famous economist who was working for Intergold, which was the predecessor of the World Gold Council. Woody Brock did a gold model, a pricing model in the early 1980s for Intergold, and he used nominal interest rates. Just throw it out. That aside, interest rates are very important. Interest rates explain what happened last week. And interest rates offer a mixed message and mixed bag and mixed prospects for gold in 2021. First off, what happened last week? You had a lot of political problems in Washington. And anybody who was surprised hasn't been listening to the news, hasn't been listening to the president, hasn't been reading, because the president was saying for 2 years that he was going to call people to Washington and they'd be marching down Pennsylvania with automatic rifles demanding that he remain president. He referred to Mussolini's call for a march on Rome, which installed Mussolini as the Duce in Italy in the 1920s. You know, this has been coming for years and everybody knew it. So it was very traumatic. B, it was not central to the world because the US has really flushed itself down the toilet, to be honest. When you have the European Union and Belgium and another Luxembourg government saying to the Secretary of State, don't bother to visit, we don't want to see you. We've really deprecated our asset and our brand globally. What was important to gold prices last week and what was important to the stock market was the rise in bond rates. And you had this strange situation where the US capital and democracy were under siege by the president's ragtag army. And the stock market was up 500 points and gold prices were falling. Of course, the simple explanation is that it was conspiracy of major banks to drive the gold price down, but that doesn't explain the rise in stocks. However, if you look at what was going on, a lot of people say, okay, well, it was the dollar. The dollar was falling, and that caused the stock market to rise. Doesn't really mean the dollar was reacting to the same thing that the stock market and the gold price were reacting to, and that was the increase in interest rates. So that's what happened last week, and that's what's been hanging over the gold price this week, and it's probably what's going to hang over the gold market next week. Because a lot of people who really like simplistic explanations for complex problems are saying, oh, well, with the Democrats now having control, or next week we'll have control of the House, the Senate, and the White House, it's going to be even bigger spending than the $4 trillion deficits that we had last year. And that's going to drive interest rates higher. And if interest rates are rising higher, what do you need gold for? Well, you need gold because interest rates are still negative on an inflation-adjusted basis, and they're going to continue to be. Now, as I said, the interest rate outlook offers a mixed bag for gold this year. Interest rates overall will remain low. On a real inflation-adjusted basis, they're probably going to remain negative for most of this year and possibly into 2022. There will be upward pressure on interest rates, but overall, the Fed and other central banks around the world will remain extremely accommodative through this year. And that's probably going to keep interest rates low. And the pressure for higher interest rates will be met by a concerted effort by the Fed to keep interest rates from rising, because rising interest rates raise the cost of doing business, buying houses, borrowing money, paying payroll, and the world and the United States economy cannot afford sharply higher interest rates. So on a long-term basis or on an overall basis, the interest rate outlook for this year is positive for gold because overall nominal and real interest rates will remain low to negative. And I want to point out on this chart here, not real interest rates on a T-bill rate basis as opposed to D-bonds. I'm sorry, I don't have 10-year T-notes here. I have T-bills. Real interest rates have been negative for T-bills for about 12 years now. And people say, well, this can't last for long and it's going to change. Well, it's lasted for 12 years, during most of which time people were saying, oh, this can't last long. And we're 12 years into what can't last long. And if you go back to the 1970s, interest rates remained negative and were even more negative at the spikes in 1975 and 1980 than they are now. But they were negative for most of 10 years, from 1970 into early 1980. Paul Volcker took over the Fed in October of 1979 and changed the way the Fed operated and started targeting inflation and raised interest rates on a nominal basis and drove interest rates positive on a real basis. And you can see that in this chart here in 1980, 81, 82. And that changed it. But you had 10 years back then, and you've had 12 years now. And people who say, well, this can't last much longer and now real interest rates are going to have to go positive, real interest rates do have to go positive at some point. But the short term can last a long time. So from a long-term perspective or from an overall perspective, we think that interest rates are going to remain low this year. And that's going to be good for gold because it will keep the real return on interest-bearing assets from the US Treasury at unattractively low levels. And again, if you look at those dispersion charts of the relationship between real interest rates and real gold prices, what you find is that it really takes real interest rates of over 3% or higher to start really having investors say, why am I investing in gold? I can get 3 or 4% real interest rates, a real return on treasuries. And no one, not even the Fed, is expecting to see real interest rates of 3 or 4% in the foreseeable future. So interest rates overall will remain very supportive of gold because the returns available will remain relatively unattractive. Now, you are seeing a rally in bond market, in municipal bond markets, by people who think that the Democrats are going to take over the world and raise taxes immediately. And I think that that's probably a misapprehension because I think they'll probably take at least a year to raise interest rates or taxes. And when they do, it's going to be a very complicated situation. But going back to interest rates and gold, there's a negative factor for gold there too. And that's what we saw last week, and that's what we're seeing this week. While overall interest rates will remain low, they will rise and fall within the context of being low. And because 90+% of financial transactions are generated by computers that look off of a treasury bill or treasury bond valuation, every little upward move and downward move in interest rates causes those computers to issue buy and sell signals on stocks, other bonds, currencies, and precious metal and commodities. So insofar as we will have some upward pressure on interest rates from time to time, that will keep the gold price from rising as sharply as it did last year when the average price was up 36%. We do think that gold prices will rise, but one of the headwinds that gold prices will face is those periodic little upward blips in interest rates, which will cap increases. It's not a conspiracy to keep gold prices down. It's a conspiracy to keep interest rates down. So that's what we see going on. Bottom line, interest rates are going to be positive and negative for gold. Overall, they'll be positive because they're going to remain low. Short term, there will be blips upward in interest rates, which will whack gold because of the valuation models that are used by so many investors and shorter term traders. So that's my views on interest rates.